Hi, everybody, and welcome back to video number 2 in chapter 12. When we left off, we were looking at income taxes payable. Businesses, corporations must prepare an income tax return and compute income tax payable. Taxes payable are a current liability. Corporations must make periodic tax payments. And the difference between taxable income completed by the tax law and accounting income completed via GAAP sometimes occur. All right, let's look at an illustration of the Margot Company, and it reported taxable income of $300,000 and its tax rate is 20%. In this case, Margot's income taxes payable is $60,000, 20% of $300,000. And we would record that as follows. We'll debit income tax expense on the income statement, but we have not yet paid it in cash, so we will create a liability, income taxes payable for $60,000. Income taxes payable balance will be remitted to government throughout the year, usually on a quarterly basis, unless you're a large company, and then sometimes they'll require us to do it monthly. All right, employee-related liabilities. Here, we owe amounts to employees routinely for salaries or wages, and we report that as a current liability. Those are related to employee compensation and include such things as payroll deductions, compensated absences such as paid time off, vacations, sick leave, and the like. And of course, my favorite subject, bonuses. Okay, so here it shows a little graphic depiction of our taxes, healthcare costs, employee retirement savings, union dues, and then the take-home pay of this particular employee. Now, that when we reduce our gross pay here by 1,667 by these taxes and healthcare and etc., that gives us our take-home pay. So let's look at how we account for that. The most common type of payroll deductions are taxes, insurance premiums, employee savings, and in some cases, union dues. Social Security taxes has been around since January the 1st, 1937, and we sometimes call federal old age, survivor, and disability insurance, OASDI benefits for certain individuals and their families. Funds from taxes levied on both the employer and the employee. The current rate, which has been around for a very long time, is 6.2% of the employee's gross pay, now up to $142,800 as the annual limit. Once you exceed that annual limit, you don't have to pay what I call FICA Social Security anymore. The OASDI tax is referred to as FICA. All right. Now, in 1965, we passed a little addition called Medicare. And initially, it was to alleviate the high cost of medical care for people over 65. And that Medicare tax is paid by both the employee and the employer at a rate of 1.45% of the employee's total compensation. There used to be some max limits on that Medicare tax too, but those maximums have gone away a long time ago. Okay, so The OASDI tax, that's FICA, standing for Federal Insurance Contributions Act, and the Medicare tax, sometimes referred to as the Social Security tax. So I call it FICA Medicare and FICA Social Security. Okay, so the combined rate is 7.65% on the employee's wages. Well, it's a combined rate, but it's 6.2% of 142,800, but 1.45 for any amount of employee wages. All right. Now, the employer also has some requirements. In addition to paying exactly what the employee pays for Social Security, the employer pays. But also the employer pays and the employee does not pay what we call FUTA, Federal Unemployment Tax. Only the employers pay that. And the rate varies a little bit. They're going to use 6% here of the first $7,000 of compensation paid to each employee. As soon as you reach that $7,000, you don't pay anything more as an employer. Now, if the employer is subject to state unemployment tax, which of course it is in California, the employer can deduct 5.2% or more. It receives a tax credit not to exceed 5.4% and only pays a 0.8% tax to federal government. So watch your arithmetic here a little bit. This is going to be, if we use a decimal, move your decimal points 2 points left. So this would be 0.008, a small amount. Okay. The state unemployment taxes vary between the states, naturally, and the employers have to refer to the unemployment tax law in each state in which they pay wages and salaries. So if you have, as I have had, employees in various states, you need to be prepared to pay differing unemployment taxes. I might also point out that state unemployment tax is, in some degree, a merit system. So if you're a good employer and you don't willy-nilly fire and hire employees right and left, you're going to get a lower rate than the employers that do have layoffs and rehires and layoffs and rehires. Okay, let's take a look at an example here of employee taxes. Here, the Central Perk Coffee has a taxable payroll of $100,000. It is subject to a federal unemployment rate of 6% and a state contribution rate of 5.7%. The employer receives a tax credit not to exceed 5.4% for the contribution paid to the state plan for that unemployment insurance. However, its stable employment experience reduces the company's state rate to 1%. Okay. Central Perk then computes its federal and state unemployment taxes as follows. It's going to take 1% of the $100,000. That's $1,000. That's for the state, SUTA. But the federal we're going to take that 6% and reduce it by the 5.4%. And that's going to be 0.006. And multiplying that times 100,000 gives me $600. So the federal and state unemployment tax is $1,600. Okay. Now that assumes, of course, that all the employees here have not reached their $7,000 maximum. per employee. And this is also based on a calendar year, not a fiscal year. All right. Now, here, let's assume a weekly payroll of $10,000 entirely subject to FICA and Medicare. I call that FICA Social Security and FICA Medicare. Federal unemployment is going to be 0.8%, and state unemployment is going to be 4%. If you're doing very well in the state of California, that's a very good rate. And with income tax withholding of $1,320 and union dues of $80, the company records the salaries and wages paid and the employee payroll deductions as follows. First, we're going to have our salaries and wages expense, and that's going to be the $10,000 weekly payroll. That's a gross number. Now, we also are going to withhold taxes, state and federal, sometimes local. We're going to have FICA taxes payable here, total of 7.65% because we haven't hit the maximum here. Normally, I'll split that between FICA Social Security and FICA Medicare. You can do that, of course. And then union dues payable, $88. So the employees are going to receive $7,827 in their respective checks or automatic payroll deposits. Now, you aren't done. The employer has some payroll taxes to spend too. So in this case, we're not going to call it wages expense as we did here, salaries and wages expense. Here, we're going to call that payroll tax expense, and it's $1,245. And that is the same number here for FICA, Social Security, and FICA Medicare, right, that the employees paid. It's duplicated by the employer, and then the FUTA tax, 0.008 times 10,000, $80, and then the SUTA is going to be $10,000 times 0.04. That'll be $400. Okay, so the summary, I'm going to be looking at payroll liabilities. We have our income tax withholding, FICA taxes, the employee share, union dues, and there's going to be other withholdings too. You know, there's vacation funds and this and that the employee will voluntarily elect to withhold, along with their health insurance, etc. But the employer is going to have the FICA taxes for the employer shares of employee FICA Medicare and FICA Social Security, but they will also pay the federal unemployment and state unemployment taxes as well. Okay, so now we'll get into a little more complicated subject, compensated absences. And here we have several of them. The first one here is vacation, but we also have sick pay sometimes and holidays sometimes. All of these are elections that the employer makes. The employer is not required to offer vacation, sick pay, or holidays. But if they do, we have to account for them. So here we're going to accrue a liability if all the conditions exist. The employer's obligation is attributable to the employee's service already rendered. The obligation relates to rights that vest or accumulate. Payment of compensation is probable, and the amount can be reasonably estimated. That looks like a good place for us to stop this video. And when we return, we'll take a look at vacation pay. Until that time, bye for now.